Hey everybody, welcome back to the Perfect Portfolio, and I'm so excited today, man. I love interviewing just innovative, disruptive people in the financial industry. I only have two settings. One is innovate, and one is disrupt for the people that know me. And I like to write disruptive books about finances. And I came across this ETF, BTGD, and I was so incredibly excited about it. And today. Fortunately, we have our guest today is David Dziekanski. He's the CEO of and co-founder of Quantify Funds, and he's also the portfolio manager. Is that right? You do all those hats, David?
Absolutely. We're a mighty team of three. We partnered with a company I spent 11 years at, Title Financial Group with, which definitely makes us a bigger player than our small three-person team. But we're very excited. New issuer to the ETF landscape, launching the stacked 100% Bitcoin and 100% gold ETF ticker BTGD in the fall in October, about 3 weeks before election. And we'll obviously get into it a little bit later on this episode. But really, the idea is scarcity. What are scarcity assets in this world that are liquid enough that you can intelligently wrap into a portfolio? And in this case, use some leverage intelligently. And by intelligently, I mean just having some form of rebalancing mechanism built into the portfolios.
Awesome, awesome. Well, as you know, we teach the buy, borrow, die strategy, which I saw your fund. I was like, wow, this is like buy, borrow, die multiple times. But in my book, Be Smart, Pay Zero Taxes, I have a rule. It says anything with an unlimited supply will go down in value, and anything with a limited supply will go up in value. And just to prove for people, toilet paper is a better investment than the US dollar because the US dollar, they can create any amount in a computer and they can't create as much toilet paper. So basically, toilet paper is a better investment than the US dollar, which I think gold and Bitcoin are definitely better investments than toilet paper. So I think we can all
Yeah.
agree on that and better investments than the US dollar. So, first of all, buy, borrow, die. Had you come across the words buy, borrow, die before? Because I know you guys are applying it, but do you ever come across that terminology before?
I've seen it. Honestly, I feel like what you do is very aligned to some hybrid between the permanent portfolio and a risk parity portfolio, which is, obviously the famous Ray Dalio Bridgewater portfolio with an appropriate amount of leverage and a tax managed lens on top. And that's why, you coined it perfectly. The richest people in this world don't really sell assets. They just continue to stack capital gains and defer capital gains. And there's a lot of value in deferring that capital gains. And as your whole methodology points out, like being able to pass the portfolio on to the next generation with all those capital gains embedded, it's almost like having a private investor who has a stake in your portfolio, but has no say, right? They have
Right.
no preference. They have no board seat. They're just a silent member on your cap table, and you can continue to grow your portfolio with them as a member on your cap table.
Totally. That's so funny. We're both here talking about like buy, borrow, die, and stacked and combining assets and correlation and whatever. So, but anyways, my background is obviously for the people who are new to following our channel. I actually dropped out of high school. I hated school. I hated reading. I went in Canada where I'm from. You can go to college without a high school diploma. So I went to college, took finance, economics. I'm in these financial planning classes, and I was like, this is not helping anyone get rich. I was like, I know it's helping a lot of, investors
Yeah.
and public corporations, but I was like, this stuff doesn't work. So I actually dropped out of college, came to the United States, read Rich Dad, Poor Dad, and just went off to the races and invested 25 years in studying finances. And I was a financial advisor. But anyways, what is your background? Did you start out investing where you guys were talking about stuff at the dinner table, or how did you get into finances?
Yeah, I actually started interning on Wall Street at a very young age. I am a born and raised New
Wow.
Yorker, so I
Okay.
started interning on Wall Street back when I was 14 years old. I was
Wow.
literally like helping advisors do cold calls out of a Morgan Stanley office back then. I spent a summer on the Amex Stock Exchange floor. I saw a third of the floor get fired there. I went to Washington University in St. Louis. So I was a triple major in math, finance, and economics. I stayed through and got my master's of quantitative finance there as well. Probably the one internship that was most eye-opening for me was in the summer of 2007, between my undergrad and my master's program. I interned at Bear Stearns on the sales and trading floor. And obviously this was, months before, like a year before the
Right.
entire bank blew up.
Yeah.
And you could just see the juice that they expected everyone who was employed there to drink. And obviously, like, who am I? I was like a 21-year-old kid at the time. We had a lot of these like lunch learning sessions where they would bring up speakers, and there'd be hundreds of people in the room hearing about certain products that Bear Stearns specialized in, and areas of expertise. And during one luncheon, I stood up and raised my hand and asked why pooling mortgages together made them less risky, and I literally got laughed at. And the guy
Really?
the guy didn't even answer the question. And I'm not saying I
Right.
foresaw anything to come, this or that, but it was just a question
Okay.
of like, if there's a risk moment, why wouldn't these kind of risk assets all move in unison, right? Where is
Right.
the actual correlation benefits there? And they didn't even answer that question. Obviously, that whole concept was at the precipice of essentially what made their entire business collapse and evaporate. And that was very telling for me, that, it made me realize that the ivory towers might look really good on your resume, but you might not necessarily be learning things, and you're kind of like following sheep. And if the top sheep know where they're going, that's fantastic. But there's a lot of big groups out there that just have this fancy logo and marketing strategy and say, trust me, and you don't really know always like the
Right.
capabilities of the people at the helm. And that changes over time as well. So it led me into a much more entrepreneurial path in the finance realm than I would have traditionally taken. I worked for a small firm called Ladenburg Thalmann directly out of college with Phil
Okay.
Boncato and Jamie Desmond. Now it's been rolled up into a company called Osaic, one of the largest independent networks of independent financial advisors and RIAs. We ended up managing about $1.8 billion of assets as an internal asset management group for that network of advisors. At the time, we were one of the larger ETF managed portfolios. So it was really fun to be at the helm of like researching all of these new and innovative products and talking to the people in the ETF industry that were actually making these products. So much so that at that point in time, I transitioned and I joined a company that is now called Title Financial Group, that now became one of the biggest ETF white labeler platforms in the world, and also obviously in the US, with about $35 billion in AUM, about 220 ETFs, and over 70 different ETF issuers, everything from small issuers like myself and our group here at Quantify Funds to much larger firms, multi-billion-dollar hedge funds, et cetera. Just because you have expertise in portfolio management, assuming that that will transition to be able to manage and grow an ETF portfolio, and all of the difficulties and communication with market makers and platforms that come alongside that, is sometimes a stretch. And so that's why Title's been so successful. I was a portfolio manager, and for a time being also head of new product development there. I was actually the second best active performing manager in ETF to Kathy Woods in 2020, and
Nice.
no one cares about number two. But at the time, I managed a portfolio for a SoFi ETF called the Gig Economy ETF, ticker GIGE.
Yep.
I spent the whole fourth quarter of 2020 saying I needed to wear beer goggles just to look at growth stocks, but it was definitely a fun experience. And that's what led us to found Quantify Funds here, was really just wanting to capitalize on our own interesting ideas. And I spent a lot of time working with someone who's a mentor of mine, Mike Venuto, the CIO and founder, one of the co-founders of Title Financial Group. And we spent the better part of a decade hunting for scarcity assets. That's like one of our common themes we were always looking for, whether it was land or land companies, TPL. Title was launched or was the advisor to one of the first cryptocurrency or Bitcoin related ETFs out there, BLOK from Amplify.
Okay.
And so we were really early in the Bitcoin space. We are lifelong allocators in the gold space, land, anything that can have true scarcity, especially when we saw how much quantitative easing there really was in this world. It was really important for, I think, and that's really what shapes my viewpoint, is like, what are those with assets going to want instead of their own currency? And that, is a long round trip to get us to where we are today here with Quantify Funds. And obviously BTGD is a prepackaged leveraged vehicle that has 200% exposure, 100% to Bitcoin and 100% to gold. We'll rebalance between those two. It makes it less path dependent than traditional leverage ETFs. So we actually coined the phrase leveraged for the long run. These are leverage ETFs designed to be held. I think everyone recognizes the need for leverage in portfolios and portfolio management. The best institutions in the world use leverage responsibly, right? It's, you know, everything has to be, it's not just like, is this good or bad? It's really how you use it and how much you're using it. I know you've spoken a lot about like appropriate use of leverage on platforms such as M1 Finance, et cetera. Actually, I love that podcast. That was a fantastic episode. But you guys pointed out, you know, M1 Finance, you might have a 200 basis point spread to short-term rates for lending there, whereas a lot of these other custodians are at 13, 14%. There's just no way to responsibly sign up for leverage at 14%. And that's where these interesting leverage ETFs come into play. We are getting leverage from futures in Bitcoin and gold. Futures markets is arguably the most cost-effective way to access leverage in the world. Why? Because if you have better rates, you're going to build a trading team and you're going to go arb that out. And then you yourself are going to make that future going forward the most attractive way to access leverage in that asset class. Now, if an asset class is not accessible in futures, et cetera, that's different. And when an asset class first gets to futures, that's different. But I think we can say in 2025, Bitcoin is a pretty mature asset. And especially the front month contracts trade exceptionally tight. So they're a very, very good choice for how to access leverage in the crypto Bitcoin space.
Oh yeah. We love it. We found out we identified 5 assets. We use stocks, ETFs, life insurance, which you can invest with no risk and taxes.
Yeah.
Real estate, super powerful if you understand tax advantages.
Yeah.
Cryptocurrency and gold and precious metals. So when I saw this ETF, I was like, it was like the sky opened up and it was like, la, like it just made our job so easy. But you also use the word quantitative easing, right? And I make fun of that in the book because the government and Wall Street make things very confusing so people don't understand it. Like, what does quantitative easing means? It means we're gonna raise the debt ceiling, another ceiling that sounds kind of friendly. No, we're gonna steal your wealth through inflation. Well, we can't steal through taxation. We're gonna just steal it silently when you're sleeping through inflation. So I mean, that's one of the things that drove me out of the financial industry is the complexity of confusing the client so they think they need these complex financial advisors. Like, I don't know, I don't think you need a retirement account to retire personally. And in fact, it drove me out of the financial service industry when I realized that if you're an 8% rate of return on your 401k, you're going to work until you die because there's the 4% rule. All these like numbers they do confuse people, right? It's just keep it simple. But anyway, so I think one thing that people are going to understand is that the government goes in debt $1 trillion every 100 days. Just saying that kind of blows my mind. Like $1 trillion every 100 days we're going into debt. So obviously Bitcoin and gold make sense, but you have the Peter Schiff versus Michael Saylor. Who's right? You guys figured out how to put the Michael Saylor and the Peter Schiffs of the world together. Give me the basics of how it works and how you guys are hedging Bitcoin, because some people are scared of Bitcoin, but gold makes them feel comfortable. How did you come across the idea of doing that?
Yeah, I think the Michael Saylor and Peter Schiff analogy is great because actually, if you listen to their message, they say they have
Yeah,
the exact same message. They just have a different solution. And honestly, if you read between the lines and some of the things that Peter Schiff has said lately, it's almost as if he's like kind of giving in to the Bitcoin crowd a little bit that it could be, but it's going to be a more volatile version of it.
yeah,
But again, the concept is, where do you find scarcity in this world? And both Bitcoin and gold make a lot of sense for that. And if you look at the actual mining rates of both of those assets, Bitcoin mines after the last halving at about 86 basis points per year. That means less than 1%. There is less
yeah.
than 1% new supply of Bitcoin on this entire earth every single year. And that number will continue to go down. We've already mined something like 95% of all Bitcoin that will ever be mined in entirety.
Right.
Gold mines somewhere right around 1.75% a year. There's about 1.75% new supply. Paper currencies print at 7 to 9% a year, right? By design, the dollar has lost 99% of its value over the last like 100 years as intended. That's what
Right.
it's intended to do, right?
Right.
Which is
Yep.
the crazy part, right? Everyone looks at gold as this asset that for a while they thought it did nothing. Now they're like, oh, has it peaked? It's gone too far. If you bought a house, a car, or a suit, or you got a haircut and you paid in gold 100 years ago, 70 years ago, 50 years ago, 10, 20 years ago, and today, it would cost you arguably the same amount for all of those different assets. So I think that's what people in the US have to really realize now. And I think the amount of government spending we've seen in COVID and since COVID have really opened the eyes to Americans of what inflation truly feels like on a day-to-day basis, and they feel that erosion of their dollar.
Right. And like I said, you could invest it in toilet paper and that would have been better investment, the US dollar. So certainly that. No. So okay, so you have 100% of the money's in gold, which people are like, how does that work? And then 100% is also in Bitcoin. So if you put
Yep.
10K in there, there's 10,000 in gold, 10,000 in Bitcoin. How does it
Yep.
rebalance itself? It's because it sort of locks the profitability of Bitcoin into gold, but then it also buys the dips in Bitcoin. How does that work?
Yeah. So the concept of stacking two assets is called portable alpha. It's not new. It's been around for decades. If
Wow.
anyone
Okay.
remembers the PIMCO Stock Plus funds back in the
Okay.
day, they used to stack stocks and bonds, and they'd have a 200% exposure, and it would be half
Really?
stocks and half bonds. And why is that? That's because a leverage ETF on its own is not a normal form of leverage, so it becomes very path dependent. You can rebalance it 4 or 5 days a week and remove some of that path dependency, but that onus is on you, the allocator, to constantly rebalance to get that actual leverage ratio you're trying to achieve. And if you're actively rebalancing, you can get there, right? But
Yeah.
portable alpha just says, well, actually, let's take the onus off of the allocator and put it into the vehicle, and let's just rebalance assets that have and display some diversification benefits between the two. And so for us, we're doing that between Bitcoin and gold. It's an active ETF. We're not trying to actively outperform anything other than represent 100% Bitcoin and 100% gold. So generally, we rebalance on a 5% float. So a 5% movement between Bitcoin and gold that'll cause us to rebalance between one asset, sell a little bit of one asset, and buy the other asset. So in reality, what does that look like? We launched a couple weeks before the election. Gold actually, while Bitcoin was running to 108,000 the first time, gold actually was just slowly losing value, right?
Right.
And so we were just methodically trimming Bitcoin and adding to gold. And actually, people were saying, "Oh, this is an interesting ETF. You're actually slightly underperforming Bitcoin." It's like, yeah, gold was
Sure.
down, right? And then the opposite occurred. Gold skyrocketed. Bitcoin dropped to right below 80,000, and we were, without emotion, doing the exact opposite. We were
Yep.
trimming our gold and buying Bitcoin. And so the value of having two assets that are pretty uncorrelated to each other and unemotionally rebalancing between the two generally leads to much better, definitely risk adjusted returns, but also top line overall returns. We learned that in the 2010s between stocks and bonds. Like, oh, you can have stocks and bonds, but if you're balanced between the two, it's even better. We're taking that within this theme of scarcity asset and doing that rebalancing for you between Bitcoin and gold. So yes, maybe you can have some allocation to Bitcoin and gold outside of BTGD, but having some that will actually teeter totter back and forth, you can say you will do those very difficult trades, but if you actively buying Bitcoin when it was at $80,000, and selling your best asset in your portfolio to do that, and if you are, kudos to you.
Yeah.
You are emotionless and just a trading rebalancing assassin without emotion, and I congratulate you.
Right.
But not a lot of people actually are able to do that. And not a lot of people want the onus to have to do that over time.
Right.
So traditional leverage ETFs come with a disclosure intended for daily use. We were able to have a prospectus that does not include the language just intended for daily use because there is this leverage of diversification or balancing between these two assets. Does
Right.
that make
Okay.
sense?
Oh, it totally
Yeah.
makes sense. Totally makes sense. So let me say this. So let's say Bitcoin was at 100,000. Actually, it was at 95 when it went to 110. So then basically you would have sold Bitcoin at like 105 and then a little bit more 110 bought gold. And then
Yeah.
as Bitcoin pulled back to what it was like a 98 this morning, I guess you would basically sell gold and buy the Bitcoin. Is that right? So yeah.
Absolutely. Yeah.
Absolutely, it's genius. And here's why I know this works, because we've actually coached over 500 people in the past 4 years. And the reason that M1 Finance specifically is so amazing is it takes the fear and greed out of it, and
Yeah,
it just emotionally does it. I mean,
yeah,
I'm honestly, I'm a horrible investor. I'm, like everybody else, we're just emotion
yeah,
driven people. And if you take the emotion out of that, it definitely helps us make investors, because typically Bitcoin is kind of correlated to the NASDAQ, where gold is not correlated to either, pretty much for the most part, right? Because Bitcoin can fall, gold tends to go up because fear comes in. Is that kind of the
yeah.
correlation we're looking at?
I would say over time, the two biggest underlying components that make up the Bitcoin movements is, I would say, risk assets, and I would actually not say equities. I would say just kind of overall M2, right? What
Okay.
is the M2 money supply, and then
Okay.
gold as well. So obviously, equities is also correlated to M2. The Qs are also correlated to M2. What is interesting is that over time, it appears the correlation to equities is becoming much more muted. Whereas, years ago, people would say Bitcoin is essentially TQQQ triple Qs, right? Like
Okay. Yeah.
3x the beta of the Qs.
Right.
Over the last couple months, you've seen it closer to 1.25x the
Yeah.
beta of the Qs. And that switch really started to occur first during Silicon Valley Bank, and also during these tariff movements as well. We're here on the 23rd of June. I would say Bitcoin has shown a little bit larger drawdowns to the Qs than it was displaying in April and May. I actually attribute that to geopolitical risks, and actually, I would say the other influence that seems to really be pushing Bitcoin a little bit right now is the dollar, right? So we're in this geopolitical tension moment, and that's causing Bitcoin to have a little bit more downside than M2 or the Qs or equities, etc.
Yeah.
But how long is that going to persist? Everyone knows, yes, the dollar might bounce, but long term, I don't really care about other currencies. In general, the dollar is by design built to lose value. And that's removing the fact that we're in this unique environment today where, as Lynn Alden says, she uses the amazing quote from Breaking Bad, nothing stops this train. We're at that fiscal cliff right now where it's really hard to turn around. We actually were using the marketing phrase the bear case for BTGD is Doge, right? Like
Right.
inflation, Bitcoin and gold can do well. Deflation, Bitcoin and gold can do well. It's
Yeah.
the stack. It's
Fear.
Doge
Yeah.
cleaning up the government's balance sheet as the singular risk to Bitcoin and gold, and that kind of has come and passed. We don't really seem to be nearly as focused at making massive changes to our spending. It's all these incremental shifts, which I understand this takes a lot of time to do, and you're essentially trying to move a Titanic. And as an American, I have hopes that we will continue to move that Titanic. But even if we do, man, just the scarcity profile of replacement rates of Bitcoin being less than 1%, gold being less than 2%. And for those that are new to Bitcoin, you should realize that there were 10 years ago, even maybe it was 7 years ago, Bitcoin's mining would increase the supply by 15% a year. It was an asset that
Right.
you almost needed to convince the next greater fool that they should like this asset. It's oh, we
Right.
need to convince 15% more people to like this asset because they
Yeah.
keep printing it. And the US had all the chances in the world to clean up their balance sheet. As you said, this QE. We started off by talking about quantitative easing. You could argue the whole concept of central banks having assets is a broken Excel loop. It's who is
Right.
actually responsible? Oh, wait, no, the government is okay. That's just a derivative of the government's balance sheet. So, that's and ironically, if you look at charts of gold and specifically central banks' interests in gold, it was really mid 2010s that central banks' interests in gold really started to peak again. Gold had a nice run when it became available in an ETF. Guess what? When people can access an investment, it changes. This is actually a paper Mike wrote because he was trading gold mining stocks back in 2004 when GLD first launched. And the correlation benefits of gold miners changed the second people could access the ETF. And that's
Right.
so powerful that access to the actual commodity over the companies and the miners in that space are now available to everyone. That's going to change the correlation benefits then of that. And that's very much shaped how I've thought over time, where, we're at, why Bitcoin 10 years ago, it's because we're heading towards this fiscal cliff. Honestly, candidly, I didn't think we'd get to this point this quick, right? I think it happened a
Right.
lot quicker than people expected, really through COVID. But that's what's sparked central banks back in the mid 2010s, increasing their purchases of gold and increasing their percentage of balance sheets invested in gold. And I think today, right now, about 30% of all gold mined is being bought directly by central banks, right?
Right.
So
Yeah.
there's just not a ton of new supply coming in there. I will say
Right.
we're at this weird moment. Michael Green, Simplify, I had a phenomenal chart the other day looking at like flows into Bitcoin ETFs and MicroStrategy purchases of Bitcoin, and then gold's return over that 1 month period. We're at this weird inflection point right now where those flows don't seem to be really buoying Bitcoin. But I could argue that could just literally be the geopolitical moment that we find ourselves in today, where there's some rallying in the US dollar, which obviously after like a big fall so far this year is the new most favorite hated asset in the world. Of
Yeah.
course, something like that will rally on a day like this today. Some people hypothesize that some early adopters had this magical number of 100,000 where they would trim some of their exposure. So yeah, we could met along in this in-between range for a little bit of time, but nothing stops this train, right? Scarcity above all else is just math. And we got by on being the quote unquote like best house in a bad neighborhood compared to the euro and the debt situation in Europe, et cetera.
Right.
And so our currency held strong because of that for a long time. And quite frankly, we got a little bit lazy with that. And we took advantage of that. And now Bitcoin and gold are looking at staring us straight in the face and saying, like, it's time to own up to that, like change your ways, or this is just the beginning, right? The actual amount of allocation to Bitcoin and gold in investors' portfolios is minuscule. Obviously, there's certain few who are very, very heavily weighted to either or both. But if you look at it from an institutional ownership of gold or Bitcoin, you're talking single digit percentages. There's a lot of room for that to grow. And everyone says, when does gold top out? I was like, well, what's your timeline? It's printing 7 to 9% a year versus sub 2.
Right.
That's all you really need to know.
Yep. Yeah, for sure. Yeah, my first book was called Rich Man, Poor Bank, and I called Social Security a Ponzi scheme. I'm like, but it is a Ponzi scheme. By definition, it is a Ponzi scheme, right? But
Yeah.
what funds the Ponzi scheme? Another Ponzi scheme called the printing money machine. That's a Ponzi scheme. You have to keep printing that Ponzi scheme to keep that Ponzi scheme. Medicare is a Ponzi scheme. Social, all of them are. It's just one Ponzi scheme upon another Ponzi scheme, another Ponzi. And people are like, whoa, I'm going to keep funding my 401k and hope to retire. I'm like, you need to wake up, people. Like
Yeah.
seriously, you need to wake
There,
up. I mean, I started the perfect portfolio because I came from middle America. I came from poverty. I'm like, trust me, you don't want to fall into poverty. It's very difficult to dig yourself out of. Like, it took me a long time to dig myself out to where I am today. So I know what it takes, and I think we look at the world and we're like, people need to wake up. Like, you literally need to wake up, and you can't sit there and do the same thing. And personally, I think if people just go to their financial advisor and CPA and say, I need to file my taxes. What should I do to their financial planner? I think for most people, they're in big trouble, right? Inflation's going to kill them. Taxation's going to kill them. They're going to get taxed to death and probably run out of money in their 401k and go back to work at 85. That's how I see the world. I'm not trying to scare people, but I want this to be a wake
or
up call.
UBI, right? Or we're just going to all be living
Yeah.
off of some form of UBI.
Yep.
Um,
Yep, I know.
there,
It's yeah, UBI, universal basic income. I mean,
yeah.
that's got to come in the future because AI is going to take away the jobs. So for people, wake up. Like you
And
need to
guess what's the
raise.
best thing to own in UBI? If we're just printing and handing out money, it's probably Bitcoin and gold.
Exactly. Yeah, exactly. If
So,
they have to keep printing money. So guys, wake up. You can't, you have to raise your financial IQ. That's why I got into this business. I think we both talked to about this. We said, like, let's simplify financial literacy. Stop making it so complicated. Like,
yeah.
simplify it so the average person can do it. I wrote the book for ordinary Americans, simple, easy to understand. And some of our biggest critics go, man, Mark just doesn't deep dive. I'm like, I don't want to deep dive. I want to keep it simple. So, but anyways, I find what you're doing is fascinating because buy, borrow, die is you buy and borrow. You guys did that for you. Buy and you essentially borrowed. You brought down the cost of debt so we can both assets. We can grow those assets forever and basically never sell. When you guys do the rebalancing, it's somewhat tax efficient in the ETF too, right? It's not going to be as taxable as if say I did it in my own portfolio.
We definitely are tax aware when we manage
Okay.
the
Tax.
product.
Okay.
There will be some taxes that will pay out in December because we do
Yep.
have to get some of the leverage through futures.
Yep.
But we can tax loss harvest, and we use some of the ETFs as well to trade in between and tax loss between those. So it is as tax advantageous as it could be. But really, it's like that small little tax is nothing compared to like the cost effectiveness of the leverage embedded in this ETF and what you can do on your own, and also removing that emotional barrier of trading the assets. Like, who wanted to sell gold for Bitcoin when like 2 months ago, right? There are very few people who are making these very, very tough emotional trades. So packaging that into 2-in-1, you can basically think our returns should be Bitcoin plus gold minus that efficient cost of financing embedded into one product.
Right.
And it's funny, we when we marketed this in the fall, we were like, oh, it's a 2-for-1 hedge against currency debasement. We were like, I
Yes.
don't really get it.
Yep.
Today, everyone's like, yes, I get
Totally.
that. Oh
Yeah.
my God.
Yeah.
You know,
You
these
guys gave when you double down, you guys gave new definition to double down. You're doubling down on the dollar right now.
yeah,
I will triple and quadruple down on the dollar. I'll buy your ETF, I'll grow it, and I'll never ever sell it. And I'll borrow from it again, which is betting down once again down on the dollar and up the S. So that's 3 times I'm betting down on the dollar. But I'll continue to do that. Anyways, everybody I talk to, consider this ETF for your portfolio, but do what I do. Buy it, never stop buying it forever,
yeah,
never sell it, access margin loans via low interest rates, and you can invest in other assets. We were doing it with where we invest into like physical gold and then borrow from it, but that's kind of expensive and then do it that way. You see, guys really made it do it. And again, we actually help people do that too if they want physical gold. There's all kinds of ways to do buy, borrow, die. But guys, invest in your financial IQ. I'd say to everybody, learn the buy, borrow, die strategy. Learn about Learn about currency debasement, and because all the wealthy people are doing it, and you can't expect it to do it. So what's the future of BTGD and Quantify? I mean, you guys were the first innovators to stack ETFs. Are you just guys going to continue that stacking, or
yep.
any cool
Um,
innovation coming up?
we have 4 other stack products in the market, and they stack what we call mega cap stocks in certain themes. So we have an AI theme, we have a cryptocurrency theme, and then we have a driverless car theme. So, for example, the
Oh,
cryptocurrency
nice.
theme is APED, APED.
Yep.
It's 100% MicroStrategy and 100% Coinbase in one ETF. And
Yep.
again, it's like, I want to invest in this area. I want to use a little bit of leverage. But are you going to do that unemotional rebalancing between those two assets? And if you saw, the last couple of weeks, obviously both are going to move with the price of Bitcoin, but all of a sudden we had this stablecoin act, which boosted up Coinbase a lot more than MicroStrategy. Well, we're doing that difficult trade and then
Yep.
trimming Coinbase and adding to MicroStrategy. So we have a similar concept there in the AI chip space, one with NVIDIA and SMCI, ticker SPICY, SPCY,
Yep.
NVIDIA and AMD, ticker LAYS. So we have SPICY and LAYS, and the chip
Yep.
side, LAYS. And then ZIPP, which is a combination of Uber and Tesla, and that driverless car theme. And so we actually have, and we have obviously more on the way. I spent 11 years at Tidal, so we spent a decade just sitting around and thinking what could be out there that's not yet out there. So hopefully a lot more exciting things to announce in the coming months as well. Thank you again very much for having us on this show. I'll one last comment on the Social Security side. I was like, you've heard some pundits, some economists say that maybe they should have purchased the S&P 500 with all those dollars in Social Security.
Yep.
But my question now is like, maybe it should be Bitcoin and gold. Maybe we should just get
I
Social Security to buy
I
Bitcoin and gold.
I kind of think you're right
So
on that. I would
yeah,
kind of agree with that. That would be a guaranteed safe bet. If you're going to debase the dollar, at least put your,
Yep.
invest the money. I mean,
Yeah.
they're kind of doing that with the currency, like, oh, the currency is dying. Let's go buy Bitcoin to back
Yeah.
like as a reserve to
Yeah.
kind. It's an interesting world we live in, isn't it? I mean, it's like
It's
it's kind of blowing my mind. But
it's terrifying
anyways,
to be honest. It's terrifying, right? Like,
yeah, it is kind of terrifying. People don't
yep.
realize that what's coming. It's a train, and there's somewhere down the road the tracks might be out, and people are like, yeah, I'll just keep doing the same thing. So,
Yeah.
anyways, guys, hey, David, thank you so much for being on this our
Yeah.
channel for the perfect portfolio. We love BTGD ETFs, and more importantly, I like how you're also engaged in helping the average Joe on to help them understand finances. We appreciate that. And we're all about perfect portfolio. That's what we stand for. I do a lot of tax consulting for rich people too, but at the end of the day, I come from a family of bricklayers, so I appreciate guys who are actually reaching out to help ordinary Americans. So, but anyways, just if anyone's watching this channel, you can learn more at our website, theperfectportfolio.com. You can get my book, Be Smart, Pay Zero Taxes on Amazon. I think it's ranked number 2 tax book in the country. So I got to get it back to number 1. I hate being number 2, you know what I mean? So, but anyways, but thanks again for thanks for being on our show, David. It was awesome interview with you, man. Appreciate it. We'll
All
talk
right.
again soon.
Thanks so much. That was a lot of fun. Thank you.